A volatility feedback loop is imminent, and it's going to bring markets to its knees. I'm your host, Steven Van Metre, and thanks for joining me today. And with the Fed reintroducing volatility to the marketplace, it's setting the stage for a feedback loop that could send stock prices crashing and bond prices to the moon. And in one of the most requested topics I've had, many of you have asked if I could go through and explain how the volatility feedback loop works, where it came from, and why it can be such a massive wrecking ball to the markets. So what I want to do in today's show is take you back in history where this came from and why it's such a dangerous problem today that is threatening the markets in a way that we've never actually seen before. In fact, we got a taste of it in March of 2020, but the next time, the Fed's not going to be able to come to the rescue. So I want to start back all the way into the dot-com bubble. And in the late 90s, a lot of insurance companies were losing business to people who were just investing in the markets because they didn't want to pay the insurance company's fees to have their money invested by the insurance company. They didn't feel there was any need to pay any additional fees when they could just buy some tech stocks and they would just simply go up. And the insurance company did something pretty smart. And they said, how do we get people to give us their money and pay us the privilege to have us invested for them? And so what they started to do in the late 90s is introduce guarantees into their variable annuity products. And these were very basic guarantees that offered some sort of payout guarantee over a period of time, or we even saw money back guarantees if things didn't work out. And investors had to hold their money there for a period of time that the insurance company set, and the insurance company collected a fee for it. And in exchange for that, they let investors take quite a bit of risk. They gave investors a wide range of investments to choose from, some of them fairly risky. And if you think about what investors would do if they're presented with the opportunity to invest, pay a small fee for the privilege of it, and have a guarantee if things go wrong that they're going to either get all of their money back in some form or another, whether it's a lump sum over time, well, what do you think they're going to do in terms of risk? Well, you've got it. They're going to take the maximum amount of risk. And there wasn't a ton of money in these products at the time, but it started gaining in popularity. The insurance companies loved it because they were essentially collecting a fee on a guarantee that they knew they would never have to pay out because the investment accounts were outperforming the guarantees by a large margin. But then the dot-com bubble burst, and the insurance companies learned a hard lesson that perhaps the fee they were collecting on those guarantees wasn't enough. But for them, it was rather fortunate that they didn't have a ton of money in these products, so it really didn't have a major impact on their bottom lines. But from an investor standpoint, after the dot-com bubble burst, well, guess what investors suddenly had an interest in? Guarantees. And insurance companies were overwhelmed with people who wanted to invest their money with some form of guarantee. But the insurance companies did learn a lesson, and one of those is you don't let people take extreme amount of risk with their investments because they'll do it. So what they started to do was build portfolio models into their investment lineup. They went to outside managers, they went to their internal managers, and they said, going forward, you can pick from one of these diversified models, but you cannot pick extremely risk options because we're not going to have them available anymore. And this idea was pretty good, and investors actually liked it. Insurance companies charged a bit more in fees because they had to recover some of their losses from the dot-com bubble, and it seemed to be a great idea. They even beefed up their guarantees to make it even more appetizing for investors to buy, and they did in droves. And everything worked out for quite a long period of time. In fact, the insurance companies were bringing in so much money. Estimates show that these products gathered somewhere between $1 to $3 trillion by the time the great financial crisis started to roll around. And this was a good thing for the insurance companies because they were making a ton of money, markets were going up, and investors were happy knowing they had some safety. But then the great financial crisis occurred, and something, rather unexpected happened. And these portfolio models, and of course it wasn't just limited to the insurance companies, but across the board, even some of the most conservative models took substantial losses. And insurance companies overnight found themselves with a massive problem. They had the obligation to pay out guarantees that they didn't have the money for, because by this point, these guarantees became lifetime benefits. And they thought that they had have no trouble paying these out. But all of a sudden, when your broad portfolio of investments drops 30 to 40%, and you still owe people for the rest of their life, well, you've got a problem. And a lot of major insurance companies were on the edge of going insolvent. And a lot of people don't know this, but the insurance industry went to the Fed and got money. Some of the insurance companies actually bought banks. Some of the insurance companies had banks, and they were able to access the Fed money to stay in business. Now, one thing that I learned in conversation with some of these insurance companies was that they never modeled any sort of major recession into their inputs in terms of what their guarantees should be and what their portfolios should be. Now, you might think that that's pretty silly, but in hindsight, other than the dot-com bubble, well, there wasn't any major market meltdown, and it was never believed that that would ever happen again. And so they didn't model it, and as a turn, they didn't collect enough fees, and they didn't control their risk enough. And if it wasn't for the government bailing them out, well, the story might be a little different today, but they did, and they learned a very important lesson, and that is they need to control risk. So what they then did is they went out to the hedge fund industry, who actually works with a lot of insurance companies to create products, and they said, look, we need a better way. We got wiped out here. We don't want to be on the hook to pay these guarantees. We want to actually make money doing this, knowing that everything will work out okay if there's another major market downturn. And oh, by the way, because the insurance companies came out of this okay, again, unknowingly to most of the investors in these products because they were bailed out by the Fed, well, guess what happened to demand for insurance company guaranteed type products? It went up. And so the hedge fund industry came out with this idea called volatility controlled or volatility linked strategies. And the concept is pretty simple. When volatility rises, well, the strategy says sell equities and buy more bonds. And when volatility falls, it says sell bonds and buy more equities. So the way this was proposed and the way this was run, you could take somebody who had maybe a risk tolerance of a 50-50 portfolio, 50% in stocks and 50% in bonds, and you link it to a volatility index, such as the VIX, which is the one that most of these are linked to. And what would happen is as volatility would go down, the strategy would actually sell off bonds and buy more stocks to the point where it could actually be 100% in equities. And the insurance companies needed this because they needed to create excess return, particularly because their fees went up quite a bit. And investors were all too happy to pay it because, again, the insurance companies were providing these even more generous guarantees than before, except now they had a new pitch to their clients. Hey, don't worry, if the market goes down, well, we've got a strategy in the product that you own to control that risk. And all it said was, hey, you could be at 100% equities at some point, but if volatility started to rise, it would start selling off those equities, and it could even go in reverse. So you back to that original 50-50 equity bond portfolio. If volatility was shooting higher, it could actually go to 100% in bonds. And that was the whole idea, is the insurance companies could charge aggressive fees, people would pay them, they could offer tremendous lifetime benefits, and the insurance companies wouldn't get wiped out if something went wrong. And it made a whole lot of sense. Now, what's interesting about this from a portfolio construction is you start to understand that a lot of people today don't actually think that bonds are any form of portfolio insurance. They don't believe it. They think interest rates can rise and bond prices can only fall. Now, when you start understanding how the bond market works, and we're going to go through the progression of how all these products, how these kind of products work, but I want you to understand this from a portfolio construction and a portfolio hedging perspective, because a lot of people don't understand that there's this ton of money. Now, if we think back that maybe there's somewhere around 1 to 3 trillion, what is in these products today? 5 to 6 trillion, maybe more. We don't actually know because a lot of these companies don't report their numbers and they don't need to. So we don't know, but we know the number is in the trillions and it's out there. So when you think about why bonds, as a portfolio hedge, because some of the feedback I get periodically is people will send me a note and say, hey, I've looked at your portfolio shield. I think you're crazy for using bonds as a hedge. It won't work. It may have worked in the past, but it won't work again. And I want you to understand that there's two components here, not only from how the bond market works, but to the underlying market structures of the products that are out there in the market that most people don't know exist. Even if they actually own one of these, they don't really know how it works. And so there's two sides to this. Is one, you have the growth and inflation story. So when growth is falling in the economy, when the economic growth is going down and interest rates or inflation is going down, well, interest rates go down toward the long end of the curve. And when long end of the curve goes down, bond prices go up. So you have that inverse correlation. Interest rates falling, bond prices rising. So that is one reason bonds are an excellent portfolio hedge. The other reason is you see there's all of these products out there that are linked to, say, volatility index. And when volatility goes up, which it tends to during bear markets, well, guess what happens? All of these products mechanically shift and sell out equities and buy bonds. Now, it's important to understand when I tell you it's mechanical, it's built into the product. So when targets are hit on the volatility index, it's not like there's a person or a room full of people or meetings that happen or conferences that people deliberate and say, well, we've hit these targets. Is it an appropriate time to make these changes? No, they're reactionary. They're formula based. They literally just follow their code. And if it says volatility hits this level, then we need to sell this amount. Or if volatility goes down to this level, then we need to add equities to this amount. That's how these products work. And when there's not a lot of money in these products, they don't have a big impact in the market. But when there's a lot of money in them, they can have a huge impact in the market. And so you start to understand, my strategy like portfolio, well, why does it do it? Well, why does it use bonds? Part of it is designed based on how the monetary system works and how bonds function as a hedge. The second reason is you start to understand the underlying market structures out there. And before we go through this again, if you've never looked at it, or maybe you have and you didn't understand that, well, there's a link in the description below and in the corner. And maybe now that little logo here of why I call myself the Bond King starts to make sense, because when you understand what bonds are, is they're literally just a long volatility asset class. And that's really important to understand. So now let's go and get into some of the charts, and I want to walk you through what happens now after the great financial crisis and how all this plays out so you can see it. Because what's important to understand now is volatility is a point where it's about to start triggering these products to sell. And when you understand that they're going to just sell en masse, and even worse, simultaneously, well, you start to understand you get a flood of selling of equities into the market at a point where there's a lack of liquidity. It drives equity prices down. And there's not a lot of liquidity in the bond market either. So if a flood of buying comes in, it's going to send prices a lot higher. And this isn't just limited to the insurance industry. If you're thinking, oh, well, this is no big deal. I mean, so what if there's a few $1 trillion in these products in the insurance industry? No, it's gotten worse. There are managed strategies that are tied to volatility index. There are risk parity strategies that are tied to volatility. There are computerized strategies. It has become a proliferation of VIX-linked strategies out there. And because they're all tied to the same thing, when these triggers are hit and they're all within a similar band of what these triggers are telling them to do, some faster, some slower, well, you start to get the idea that if there is a breakout in volatility, well, there may not be anything to stop it, and that creates a reflexive feedback loop of higher volatility leading to more and more selling of equities and more buying of bonds. All right, so let's take a look backwards in time here. And let's go to this chart here where I've got the VIX. And I want you to see now that going into the financial crisis, we obviously know that there wasn't a lot of these products out there in the marketplace. There were some. I mean, they weren't brand new. They just became widely used after the great financial crisis. So you see volatility rising, and it kind of gets in this zone of the VIX where I've got these two lines. They're at 31 and 36. And then all of a sudden, it gets out of control. Volatility shoots up to the highest level we've seen in history, and look what happens to the bond market. Now I've got a TLT here, which is a long-term U.S. Treasury ETF in white, and what you see is volatility is rising, you notice bonds rising. Again, they're a long volatility asset class. And what happens is you see a big spike here in the VIX. And what happens, you get a big spike in bond prices going up. And then all of a sudden, what happens next? Well, the Fed steps in. And we get introduced to something called quantitative easing 1. So let's go on what the story is. And that starts from late November 2008 and runs to the end of March 2010. And the reason we need to talk about QE is because we want to understand what it does in terms of suppressing volatility, but it also, when it's over with, what happens? We usually, and we've talked about this in the show before, is you tend to get a spike in volatility or periods of heightened volatility. And you start to understand that, hey, that could be really dangerous if volatility gets too high and starts triggering all these products to start selling. And if you're thinking that, well, you're on the right path. Let's continue on here, because what happens at the end of QE1, volatility spikes, but the market is able to get a bit of control of that, and it does, but then if it can't hold on to it and volatility spikes, well, again. And so the Fed says, hey, you know what? We're going to come out with QE2 and we're going to get control of these things. And that starts in November of 2010 and runs through the end of June 2012. And all of a sudden, the Fed's able to bring volatility down. And so what we're starting to learn is that QE does suppress volatility, and that actually is helping all of these volatility controlled products stay long the U.S. equity market. Now, remember, at this point in the story, we're starting to see these companies and products being sold a lot. I mean, they're easy to sell, especially after recessions, and people are starting to buy them. So money's flowing into these, and the Fed understands how this works. And so they know they need to keep volatility down to prevent some of these products from unwinding and setting volatility back higher and stocks down with them. So we now see QE2 ends here. And the good thing is now the economy is getting back on its feet, and so volatility stays relatively low. And what we'd expect from these products and money flowing into it is that they would take longer and longer equity positions, and that makes perfect sense. And so we get into QE3, which starts mid-September 2012 and runs all the way to the end of October 2014. And what happens at the end of October 2014? Well, we see volatility start to rise up again. But here again, we come back to the story is the economy is in fairly good shape at this point. So it's able to absorb, this heightened period of volatility due to the end of QE3. But what comes after that? Well, we almost have a breakout in the VIX above this 31 level in two separate times. And this would be in the late 2015, 2016, when we had that big double dip in the stock market. Now, what's notable here is after QE ends, what do you tend to get? Is you tend to get periods of heightened volatility. It's normal. It's just a sense volatility never went away. It's that the Fed was suppressing it. And when you suppress something for a long time and then you stop suppressing it, well, it comes back, and it seems unusual. But here again, the market was able to get a hold of the situation and keep the volatility genie back in its bottle. So let's continue on with the story here. Because after those two volatility spikes, well, what happens? All of a sudden, the VIX is going down. And again, more and more money is floating into these volatility-linked products or volatility-controlled products, and they're taking on larger and larger equity positions. So as more money is flowing in, they're reflexively causing volatility to stay down and markets to go up, because the more money's flooding in, you start to make sense, is they're allocating more of that money to equities and less to bonds, and that is acting as a volatility suppressant in itself. So that's pretty cool. Let's go on, because now we get into late 2015, and the Fed says, hey, we're going to start hiking the federal funds rate, and you'll notice that there's a spike in volatility here. In fact, volatility starts to come back until the market starts to adjust, but it takes the market, over a year to kind of get used to that. But you notice there's periods again of heightened volatility, because the market doesn't like things like the end of QE, and it doesn't like things like rate hikes. And guess what's coming up next month? Well, the quantitative easing at the time of filming is ending in 2 weeks by mid-March. And then what's going to happen then? Well, we know there's going to be at least a 0.25% rate hike, possibly a 50 basis point rate hike. And that's going to bring volatility back. So I want you to be thinking that, hey, volatility is coming back in part due to the fact the Fed's no longer going to be suppressing it. Let's keep going. So then the Fed says, hey, in October 2017, we need to do some quantitative tightening. We need to unwind our balance sheet. And they're gonna run that for 2 years. And what do you think is going to happen now? Do you think volatility is going to go away? Well, you would expect to see volatility maybe going up again. So let's take a look and see what happens. And here is where this red arrow is where they start quantitative tightening, and here's where they ended. And I want you to know it, and when we're done here with this piece, we'll see that they're going to restart quantitative easing right at the end of this. But I want to notice how when they're unwinding their balance sheet, volatility's back, volatility's back, volatility's back, and it's knocking on that door. Now, why does that 31 to 36 range in the VIX so important? It is because based on my research, where I believe the range where these procs start to unlever their equity position, where they start to actually sell their stocks and buy bonds. And if it gets out of that range, well, then it's a big problem. That's where you start to see the feedback loop. So somewhere in that band is where I believe we start seeing this occur. And again, the more money you have in these products, the more products like these that are out there, the more of them that are going to hit their triggering mechanisms. All right, let's keep going. So here, now I'm going to overlay the TLT again in white. And again, just to refresh your memory, that is a long-term treasury bond fund. And so if we look back now, say over the past 2 years, what should we start to see is more instances where you see rise in volatility, rise in bond prices, rise in volatility, rise in bond prices. And why would you expect to see that? Because of these volatility linked products that are literally, as volatility goes up, what are they doing? Selling equities and buying bonds. You got it. And so you would expect to see this relationship now show up repeatedly. So let's look some more. Here you see volatility starting to rise a bit, bonds heading higher, volatility up, bonds up, volatility up, a little move higher in bonds, a second move in volatility triggering a big rally in bonds. And so now all of a sudden, we're seeing something a little different because then we get into the pandemic. And so what happens before we get to the pandemic? The Fed comes back in with QE4. Now, in October of 2019, you have to remember the amount of QE the Fed was doing is relatively small compared to the 120 billion we're used to having during the pandemic and the years following that. So just keep in mind the Fed went from QT to QE, and then all of a sudden, the pandemic hits. And so what happens next is you get this big surge in volatility, and guess what happens? These procs are unwinding, selling equities, buying bonds, sending bond prices vertical. And then what happens? The Fed ramps up its QE purchases, goes just ballistic. I believe it did $1 trillion in a month. It did a lot. And then, of course, it backed off to the amount we know now. And what was the Fed trying to do? Yeah, suppress volatility. And so when you understand that it's suppressing volatility back down, what are these products that just went and unloaded all their equities and bought a bunch of bonds going to do? Well, now they're going to sell those bonds. Who's got to buy them? Fed. And buy it back in the stock. So the Fed is engineering a market rally. And then on top of that, as Mike Green will tell you, you also have these passive strategies, these target date funds. And because bond prices went up, well, they needed to sell bonds to reweight. Think of it like this. You have a 50-50, stock bond portfolio, and now your bonds are 75% of your portfolio, and you need to be back at 50-50. Well, what are they going to do? They're going to sell bonds and buy stocks. So you had these two mechanisms simultaneously unloading bonds. Of course, again, the Fed knew this, so they had to buy them, and driving equity prices back up. And so a lot of people think that whatever was driving the equity market was something else. It was actually a lot of these reflexive strategies at the hands of the Fed putting the volatility genie back in the bottle. And what happens now is due to the pandemic, we see spikes in volatility, but they're being suppressed due to heavy amounts of quantitative easing. We see bond prices come down, and then they come back up, and now they're down. And of course, what does everyone think is bond prices are going to go down again and forever maybe, but that's not the case, because what you start to see now is as volatility is going down, bond prices come down, and if volatility is bottoming and starting to come up, bond prices are anticipating that. And then all of a sudden you see volatility down, bond prices down, and then volatility starting to rise, bond prices to rise. And notice how it kind of gets up here and you get these bit of a jump. But now something interesting is happening As we're seeing bond prices go down and volatility goes up. Now, what does that mean from a market perspective is, the market believes the volatility is going lower, so they're selling and shorting bonds in the anticipation that volatility is going to go down. And you have this very deep short position in the bond market. And of course, what would happen now if volatility were to break out? Well, you got it. All these strategies are going to start selling stocks and buying bonds at a point where everybody's betting on the other end of this, the other direction, and that's going to cause even more pain for the people that are short the bond market. And again, what are the couple of the triggers that could see volatility rising? Well, the end of QE, which is coming, and rate hikes, which are coming. And perhaps because of inflation being so high that we might even get a more aggressive rate hike schedule than we've seen in the past. And that just brings back uncertainty into the market. So let's go on to the next slide. Now, you'll notice I've zoomed in here because what have we seen lately as QE is being unwound and volatility is being reintroduced to markets? What's happened is we're getting into this danger zone, this 31 to 36 range. And you see here, okay, bond prices go up, and then all of a sudden the market says, let's drive volatility down, bring bond prices back down. Volatility comes up, and the market's convinced the volatility is going to come down, so they keep selling bonds. So look what happens, volatility comes down. Now volatility spikes, and what are they back? Okay, we're going to sell some more bonds because we're sure about this time. But again, now we're 2 weeks away from the end of QE. It seems that as we scale back, or as the Fed scales back its purchases from 120 billion to 90 to 60, down to 30, that it's just reintroducing volatility. And what we're seeing here is 3 times here in a short period of time, we're back in that danger zone. And at some point, these products are going to start triggering. And if you might see me post on Twitter that, hey, the vol sellers had one job today, and it was to get volatility down. And the reason that is because some of these strategies actually adjust during the day. A majority of them, a vast majority of them, are based on where volatility closes at the end of day. So as long as if volatility starts high and you can shove it down by the end of the day, products don't trigger. But now you see, so how this can get really ugly. If volatility gets high enough, you have trillions of dollars in these volatility-linked strategies of an unknown number, but in the trillions, that will all start simultaneously selling stocks and buying bonds. And at the time, right now, there isn't a lot of liquidity in the equity market, which could then trigger a massive unwinding in stocks as there's nobody there to buy them and send them drive them down. And at the same time, due to all these people that are short the bond market, you have a flood of money coming in, sending bond prices to the moon. And of course, what happens when bond prices go up and interest rates go down, it's a signal of tight financial conditions. And from the Fed's perspective, if long rates started to collapse against higher short-term rates, well, now you have an inverted yield curve. What happens next? Well, the banks cut back their lending or even stop lending in a broad way. And then you start to think about, well, what will the banks do? If they're not lending against their deposits, what do they have to do? Oh yeah, they have to buy bonds to back all their deposits because we know the money supply is going to continue to grow. But ideally, from the bank's perspective, they would be lending. But if the curve's inverted and they can't make money lending, what are they going to do? They're going to buy bonds. And what happens during periods of high inflation with foreign investors and foreign central banks who are exporting to the United States where prices are high and their costs are lower? Oh yeah, they're buying a whole bunch of our bonds too. So all of a sudden, what you see is there's a shortage of bonds and perhaps a trigger point that could lead to a massive buying of bonds and a massive selling of equities. And then you start to understand that perhaps, there is something to, hedging portfolios with bonds. Perhaps there is something special about strategies like Portfolio Shield that use bonds as their hedge, because there are periods where hedging your portfolio doesn't work, where you can be hedging and your returns aren't there. But then when these trigger points hit, man, your hedge looks like the most brilliant thing ever. And that's what I want you to understand is we are on the edge of a volatility explosion. What's going on between Russia and Ukraine right now is just adding to that story. But sellers are continuing to try to short volatility. And what we're seeing is the Fed is reintroducing it by ending quantitative easing and starting to hike rates. When you start understanding all of these factors and put them together, you understand that why we're on the edge of a massive feedback loop. Now, let's hope that never actually happens. But if it does, you could see the biggest spike in VIX, the biggest crash in equities that you've ever seen in your life. And if you understand that, well, again, you come back and you know what this little logo, perhaps it really means in terms of why I call myself the Bond King. And with that, I'm Steve Van Metre. I appreciate all of you for being fans, supporting the show, and taking the time to watch this to learn. And I hope it really helps your understanding of why, when you see a proliferation of products that do the same thing, well, it's generally not good. It can be very good for a very long time, but someday, hopefully not anytime soon, but someday in our life, we will see volatility get out of control. And this time, because of inflation, the Fed's not coming back with QE. I'm Steve Van Metre. Bye now. The content of this video is provides educational information only, is not intended to provide investment or other advice. Zero to be construed as recreational solicitation, buyer selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Advising or Steven Van Metre Financial.